Hello, Future Finance family, and welcome to a new video of FMTTM Future of Finance, where we demystify the world of finance and investments for you. If you're seeking to solidify your investment strategies or simply eager to dive into the ocean of financial knowledge, you're at the right place. Today's discussion revolves around a buzzworthy and time-tested investment technique, dollar cost averaging. As the world of digital currency continues its rollercoaster ride, many investors ponder on how best to navigate its turbulent waters. Can dollar cost averaging be the anchor you've been seeking? Is it the magic formula to maximize returns and minimize risks in the tempestuous tides of cryptocurrency? Let's decode, dissect, and determine if this is the optimal strategy for you. Before we get into today's video, I just want to take a moment to remind you that investing always carries some level of risk, and it's important to do your own research and consult with a financial professional before making any investment decisions. This video is for educational purposes only and is not intended to be investment advice. What is dollar cost averaging? Commonly known as DCA, is a systematic approach to investing that involves allocating a set monetary amount towards purchasing an asset at regular, predetermined intervals. This strategy is employed regardless of the fluctuating price of the asset. By committing to this method, investors aim to reduce the risks associated with timing the market and the effects of market volatility. Instead of attempting to predict the best times to buy low or sell high, DCA ensures that an investor is consistently buying. Over a period, this could mean purchasing more of the asset when prices are low and less when prices are high. The objective? To achieve a more favorable average price per unit over time, making the investment journey smoother and potentially more predictable. Is dollar cost averaging a good idea? It's a query that resonates with many, especially those new to the investment realm. Is dollar cost averaging, often abbreviated as DCA, genuinely a commendable strategy? Let's dissect this. The allure of DCA often lies in its sheer simplicity. Instead of constantly gluing oneself to market charts, or stressing over getting the timing just right, this method liberates you. There's no need to predict when the market will hit its lows or scale to its highs. Instead, you maintain a routine, investing at predetermined, fixed intervals, taking much of the guesswork out of the equation. Financial markets are inherently volatile, and when you venture into the realm of cryptocurrencies, that volatility can feel amplified. Here's where DCA shines. By sprinkling your investments over time, you potentially reduce the sting of short-term price fluctuations. Rather than buying all at a peak or a trough, you spread out, capturing a market average. Emotional stability. Emotional decisions and investments can be a tumultuous mix. FOMO, fear of missing out, or panic can drive rash decisions, be it a hasty purchase during a surge or a panic sell during a downturn. DCA encourages a systematic approach, sidelining emotions and promoting a calm, pre-planned investment strategy. One of DCA's standout features is its adaptability to diverse financial situations. Whether you've earmarked a modest $50 or a more sizable $500, you can still employ this technique. It's not about the sum, but the consistency. However, a word of caution. If you're someone with an acute sense of market movements, possessing a knack for predictions, and thrive on active trading, DCA might feel a tad passive. Yet, for a vast majority, especially those eyeing long-term growth, DCA stands out as a strategy that instills discipline and promotes steady growth. To truly grasp the effectiveness of dollar cost averaging, DCA, it's beneficial to walk through a tangible example, placing it within the context of the dynamic world of cryptocurrencies. Consider this scenario: you've resolved to allocate a portion of your monthly income, say $100, towards investing in Bitcoin, a leading cryptocurrency. The beginning of the year, January, witnesses Bitcoin trading at a robust $10,000 per unit. Consequently, your initial $100 investment secures you a modest 0.01 BTC. Not too shabby for a start. Fast forward to February, and the often unpredictable nature of cryptocurrency markets manifests. Bitcoin undergoes a significant price reduction, plummeting to $5,000. Given this decrease, your subsequent $100 investment now allows you to purchase 0.02 BTC. This means, over a span of 2 months, by consistently investing the same amount, you've amassed a total of 0.03 BTC, having spent only $200. Now, here's where the magic of DCA shines. When you average out the cost of your Bitcoin acquisition over these 2 months, it works out to approximately $6,666 per Bitcoin. This is significantly less than the high of $10,000 you would have bought it if you dumped all your investment in January. The primary takeaway here is the inherent strategy DCA employs. By distributing your investments over time, you inherently purchase more of the asset during price dips and less during its peaks. Over a prolonged period, this strategy endeavors to average out the cost of acquisition, potentially shielding you from the brunt of market volatility and minimizing the risk associated with trying to time the market. Dollar cost averaging, DCA, isn't just a recent buzzword, it has historical significance that dates back to traditional stock markets. Many experts argue that the very essence of this strategy is captured most effectively when applied to long-standing indices like the revered S&P 500. The S&P 500 is more than just a market index, it serves as a reflective mirror of the U.S. economy's health, encompassing 500 of the nation's largest publicly traded companies. Its trajectory over the decades showcases periods of highs, lows, and everything in between. This very volatility, albeit milder than that of cryptocurrencies, makes DCA a suitable strategy for this investment avenue. Here's a consideration. What if, instead of trying to time the market or making impulsive decisions based on daily news, you took a disciplined approach? Suppose you were to allocate, for instance, $200 each month towards an ETF tracking the S&P 500. This systematic investment would mean that during months when the index rides high, your fixed amount might buy you fewer shares. Conversely, during a downturn or correction phase, the same amount would fetch you more shares. Over time, this consistent strategy can work wonders. Consider the S&P 500 as a vast ocean with its tides rising and falling. Trying to predict its next move would be as tricky as predicting the ocean's next wave. However, with DCA you're not trying to predict. You're setting out a small bucket at regular intervals, come rain or shine. By aligning this methodology with the S&P 500's historical upward trend, you're not merely hoping for profits, you're strategizing for them. Over the span of years or even decades, DCA helps in smoothing out the purchase cost, aiming to offer a safety net against the pitfalls of unfortunate timing or short-term price drops. How to execute a dollar cost averaging? Venturing into the crypto world with a strategic mindset? Dollar cost averaging, DCA offers a disciplined approach that might just be your guiding star. Ask yourself the pivotal question, why am I investing? Whether you're looking at a leisurely retirement, saving up for a substantial purchase, or aiming for substantial wealth accumulation, your goals will set the foundation for your DCA strategy. While Bitcoin and Ethereum often steal the spotlight, there's an array of altcoins waiting to be explored. Dive deep, research, and select. Remember, your chosen asset should resonate with your risk tolerance and investment horizon. Money matters. Determine a fixed, non-negotiable amount you're at ease with. This could be a percentage of your monthly income or a flat figure. But once set, ensure it's a sum you can consistently allocate without affecting your day-to-day finances. Consistency is key. Decide on the frequency of your investments. While monthly intervals are popular, you could opt for bi-weekly or even weekly installments. Irrespective of your choice, adhere to the rhythm. A static plan in a dynamic market? Not the best idea. Make it a ritual to evaluate your portfolio annually. Gauge your asset performance. Perhaps you'd want to channel more funds into your investments or maybe diversify into newer crypto territories. A final word of wisdom: patience. DCA isn't about short-lived adrenaline rushes. It's a marathon, not a sprint. Market dips? Stay unfazed. Sudden surges? Hold back the impulse to go all in. Trust the DCA methodology, and more importantly, trust the journey you've embarked on. In the vast landscape of investing, dollar cost averaging emerges as a beacon for those seeking consistency. Its systematic methodology shines particularly in the unpredictable tides of markets like cryptocurrency. By setting a predictable course, DCA empowers investors to navigate away from the rocky shores of guesswork and the stormy seas of emotional decision-making. This tried and true method holds its ground, providing stability for both those just embarking on their investment journey and veterans who've weathered many a financial storm. Yet, a sailor must always be wary. Before raising your DCA sails, chart your course wisely. Dive into comprehensive research, and perhaps even seek the guidance of financial navigators or experts. Always ensure your strategies, DCA or otherwise, are charted towards your distinct financial horizons. Thanks for watching FMTTM Future of Finance. If you found this video useful, don't hesitate to hit that like button. Stay in the loop with more deep dives by subscribing. Are you using DCA? Share your experiences and viewpoints in the comments. As always, remember that informed decisions are the cornerstone of wise investments. Until our next video, keep gaining knowledge and making informed choices. Looking forward to our next session together.